So the first chart we're going to review is that for XLE, which is the energy sector fund. This is a daily chart. You can see the ride since the beginning of the year has been quite volatile. We hit a high in January of around 78. We recently tested that high and then came back down into the mid 70s. Now, due to the volatility, energy is not one of our favorite things to trade, but we certainly can learn some things about charting as well as get a handle a little bit on where oil prices are headed, which often has effects on the economy and other stocks by looking at this chart. So we'll start by looking at the price action early in the year. We see it reach a peak here and then a big move down on huge volume, which seemed to suggest that there was going to be a major move downward. This almost in one move was climactic. As you see here, these volume bars are the highest on the chart. And right at the bottom, this bar here, we see the price come way down into the 64, 65 range, but finish with this notch well above 65. So there was a lot of volume pushing the price back up here, and this has been a point below which the stock has not moved again, despite sitting around here for nearly a couple months, challenging down this way again. Now in mid-April, we saw a lot of buying volume come in down here, and you see predominantly these green bars with very high finishes to the right notch, which is the suggestion on the bar of the closing price. We see after that aggressive move upwards into the lower 70s, an area of chop here in this rectangle, which is quite common after such a move. The price action on almost any stock or exchange traded fund after an extended move is either going to pull back and retest an area, or if you're holding it, you would certainly hope for just simply some price action that consolidates, typically letting the 20-period moving average catch up, and that amazingly seems to be when that happens that the next move goes forward either way. So what you see here around this rectangle and what you look for when you see a period of consolidation is to try to get a handle on the finishing price of the bars as well as volume coming in. And typically at the end of a consolidation, you'll see volume coming in, which you see here in this rectangle. And then you see this bar here where you have fairly high open, you challenge down, shake people out, but finished up near the top. And then on subsequent high volume, a explosion and gap higher, and the price goes on to make a new high. Now, unfortunately, what happened there was we essentially upthrusted this prior high where the price currently went above that level and then finished down. If you look carefully, you'll see that this blue bar engulfs the prior day's bar on very high volume, and this is quite bearish. And in fact, the exchange traded fund moves down about $5 or so. Now, as much as this may seem bearish to go up, challenge that high and fail, we never really came back and retested the breakout area here, which is quite common for stocks and ETFs. And that seems to be what we've done so far. We came down. It's common to break through that area to shake people out again who've placed their stops there, and then the price goes back up. And if you look here on relatively high green volume there, and now we're consolidating around the last couple days. So for the moment, XLE, I think the uptrend remains intact despite the break of this channel here that I drew. And this would kind of be this bar here where you have the high volume in this rectangle for these several bars. A break below that action would suggest maybe we go down and retest this area here and even test some of the lows. So now we're looking at XLF, which is the exchange traded fund for the financial sector, contains many of the banks, brokerages, etc. And there's a pretty obvious pattern for an obvious reason here. As we see starting in February, some selling volume came in coinciding with all the marketility we saw in other sectors. We see this similar chop in price up and down as we watched over those 2 months in other sectors. But what we see is a continued failure to make new highs. Banks are very interest rate sensitive, and so this move down coincides with rising interest rates. If we look down in the volume bar area, you can see most of the volume has been associated with selling. Now, what is interesting to me here is we came down and broke through this support level a few days back on very high volume, but finished above that price and have sort of held with persistent large volume. And that's kind of where I wonder whether this might not go up, because even though you've got this descent here rise in the face of rising interest rates, each time you've had selling come in here and here and here and then here, we haven't been able to make a new low. So I view this as unresolved, and certainly I don't think a rally through the summer, although it seems that tech is going to move along perhaps by itself, but I don't believe the entire market can rally without the financials participating. So I think you look for a potential break down below here to be problematic, not only for the financials, but also for the stock market itself. Whereas if we can break above these intersecting lines here and sort of move towards new highs with some buying volume coming in, I think that'll be quite promising for the banks as well as for the stock market. So that's something to really watch for in the next few weeks. Now, one other point on this chart that I noted previously, and I'm just reminding myself about, is if you look at this area, this long rectangle here, and what I'm trying to note is we always talk about, and often we get questions about where to draw lines of support. Now, and resistance, we like to look left, as our mentor taught us, looking for areas of high volume breaking through a significant area on that volume. And so we can see here this large area of volume breaking sort of through here. And so we thought this was a good place to draw a zone of resistance, a zone of support after it broke forward. And what you can see is how we come down and test it and hold, test it and hold, test it and hold, and again test it and hold. So it's really amazing how this exchange traded fund and stocks in general, when there's some high volume area, even going back months or even years, there's a lot of buyer and seller memory around that price. And the reason those levels hold is because people who bought at a level where a price broke through are going to want to get their money back when the stock approaches that area. People who have sold short and are losing money when the stock goes up, when they get a return back down to that level, they have a chance to break even as well by covering. So these areas are strong for a reason. Moving forward now, we're looking at XLI, which is the industrial sector fund. These have had a rough go of it for most of 2018 after January, and we see very much a similar pattern to what we saw with XLF, with this long line going back to this high here, very high volume here that served as a point where we could draw a line, and this has served as support. Even when it broke through here in a false breakdown, the price moved back up. We see from the point that the industrials turned down in February, there was a series of lower highs suggesting a downtrend, and for which we drew a downtrend line. What's important to note is we now have broken back up through that area. Although I really don't like the price action here. We got a little bit of elevation, but then we see a poor finish on this bar, a poor finish on this bar, and a poor finish on this bar with some selling volume coming back in. I think it remains to be seen whether the industrials are going to rally from this point. We're nearing this support line again. And I think what you really need to look for, just as this selling wave started with all of this selling volume, And this buying wave started with all of this buying volume down here. You need to see some evidence early on in a move back up that there's significant buying coming into this exchange traded fund, and we just don't have that evidence yet. So I would avoid the industrials until you have such. Moving along, we're now looking at XLV, which is the healthcare sector exchange traded fund, and this would contain things like pharmaceuticals and medical supply companies, etc. This is a weekly chart of XLV, and we can see that from the fall of 2017, it was in a nice tight up channel, and then some high volume came in again around the time of the market downturn in February. But since that time, the sellers have had a hard time pushing prices lower, and we haven't seen as much selling volume, and maybe some buying volume came in here, but without any progression. You can see the volume, green volume bars there, and we're really just sort of tightening up here and winding up. I have a hard time saying which way this is going to go. And again, I would like to either see, if I was going to sell short the healthcare sector, some more selling volume come in, or if we can break out above this bar, I think that might be decisive. If there was a buying bar with some good volume and a good position on the close, that's the right notch on the bar, I think we could say there's a chance that healthcare will move up. But for now, I think it's a do not touch. So now we're going to look at XLY, which is the exchange traded fund for consumer discretionary stocks. Among these would be things like Disney. We're looking at the weekly chart of XLY, and we can see it has been in a very slow up-moving trend for a couple of years now, as denoted by this trend line that I've drawn. That has provided support at many points along the way since 2016. Like many other stocks, XLY had a very accelerated run into the end of 2017 and early 2018. This was a very bearish looking bar on extremely high volume. You can see here, very long ranging bar, although again, as we saw with many price bars in this time period, a relatively high finish, and then some volatility as we saw in the spring, and the price action sort of formed a wedge like this that was symmetric as price tightened, and it looks as though we're breaking to the upside here. You can see the selling volumes diminish, buying coming in, and if you look, the closing prices on each of these bars is favorable. The buyers, even in the small bars, seem to win at the end of the week. And we're starting to break out here, so I think there's some hope, especially if the rest of the market goes. I think this may be a good place to be, and it's been winding up for many months now. This could be a really nice move. Now, one of the sectors that has not looked so well is consumer staples, which includes things like cereal, basic food products, and basic hygiene product companies. Unlike other stocks and exchange traded funds that have rallied after the rough period in late winter, early spring, the staples have had somewhat of an ugly downward trend, as we can see here, with lots of selling volume. Now, one thing we do see is evidence that the rate of descent is slowing, and there's some shortening of the thrust, where we see a low here, a low here, and a low here, and the vertical space between these lows is tightening, suggesting that the move is tiring. You can also see this depicted with this descending wedge. Descending wedges typically end in an up move, and ascending wedges more commonly end with a decline. although there are no hard, fast rules. As of the moment, we do not see any evidence of buying. I will tell you, though, we are seeing price action that we have been predicting on our Facebook page for many stocks over the last few weeks. The price action we're seeing here is similar in that you see some tightening and that you have this wide-ranging bar, and now the last several bars here are all inside that bar and of a much shorter range. This suggests that the stock is getting, or the exchange traded fund is getting ready to move. So we think staples are going to break one way or another. If you were looking to play a rebound here, this is typically what we look for. How to decide when to play out of it would be, one, a break above this high volume bearish bar, and then the break would be on high green volume down below with a good close, and that would then give you a good risk reward to go into this exchange traded fund or the stocks within this sector, putting a stop somewhere below this price action here for a relatively good high reward to risk ratio. This is a weekly chart of XLB, which is the materials sector exchange traded fund. And we see a somewhat similar pattern to that which we saw with XLY, with this uptrend since 2016, a decline this winter, early spring, and then a symmetric triangle where we're tightening and probably getting ready any week now for a big explosive move to either direction. Now, as you can see below, volume is basically declining, whether you want to draw the line from this high volume area or just simply even down through here. So we think in the next week or two, you should be looking for not only a good looking price bar, but for volume to expand, and that will help you determine direction or a true break versus a false break. Often what happens before the real move is that a stock or exchange traded fund will break outside what seems to be the drawn trend lines or support and resistance levels, but the move isn't true. One, because the price action finish is not supportive, but also you don't see good volume pushing it on the way out. So look for both here if you want to consider the material type stocks. Currently, the sector we've been following the most on our Facebook page, and the one that seems to have the most charts with bullish appearances, and we've been featuring these charts for many weeks now, is the technology sector. The Alibabas, Apples, Facebook, Twitter, to name a few, Netflix, another one that we've been watching carefully. And what we see is a long uptrend again. There was this move down towards the beginning of the year, but then you could pretty much call this double pressure, where you have this big move down on very high volume, and then some buying volume came in that was significantly higher than most of the volume behind it, where we exceeded the high of this red bar, pushed up, pulled back into it, which is quite common to retest the area, and now we're headed higher again. And the selling pressure seems to have diminished. Now, you may say, well, this volume's only moderate, but that's often common in a wall of worry where you grind higher on low to moderate volume, and you can pretty much see here, good finish to this bar, good finish to that bar, good finish to this bar and this bar. So most of the bars in this series, the buyers are winning at the end of the day, and we're almost broken out to new highs. We think if you see more buying volume come in on this breakout here, that this has significant room to move this summer. But again, we need to wait for either significant price action and volume to come in and confirm a new high, or you could take a position with the price somewhere in around here, sticking a stop somewhere here or here for a pretty good reward to risk, in the sense that we think this may go significantly higher if there's good volume behind the next bar or two and a good close. Now, similar to the staples, the utility sector has had a rough go of it lately. Both these sectors, because the staples pay typically large dividends, as do the utilities, are very interest rate sensitive. So with the rise in interest rates over the last several months, it is all but predictable that these stocks would decline. Now, what we see here is that in 2017, the buyers were pretty much in control with a nice uptrend, although the rate of acceleration upwards was declining, and you ended up with a little bit of a ascending wedge here. And suddenly you have all this selling volume come in, suggesting perhaps a first wave down. There was a rally back to the point of breakdown here in April, and then a move back down. I don't like the finish on this bar, this weak low, failing to make a new high. This chart is bearish, and I would need to see a lot more evidence before I would go into this sector, especially if you continue to see interest rates rise. This is the weekly chart for XTL, which is the telecommunications sector. This would include such things as Verizon and AT&T. It's an interesting looking chart. I've drawn this rectangle to depict a very long area of wide consolidation since late 2016, going all the way to now, several false breakouts, and then we're getting into this symmetric triangle. I think when you see consolidation like this, you can see the best way to play a range like this is to try to find evidence of strength at the bottom of the range rather than trying to play a breakout. And so I would be very hesitant to take a position in here unless I was really overwhelmed with the strength of the move, the position of the close, and volume. So I think this is a wait and watch at this point. Finally, this is IYR, which is the Real Estate Investment Trust Sector Fund. This sector had a rough go of it towards the end of 2017 and early 2018, and we see a fairly typical good teaching point here, selling climax. You can see all this volume come in where people are panicking out of the exchange traded fund, but for better or for worse, they're selling into the smart hands who are buying in here, and you see that come out in the stock or exchange traded funds slowly move up. This is quite volatile. You can see very quick cycles of movement up, sort of 1.5 steps forward, 1 step back, but it's creeping upward. Not always clear how these will do in a higher interest rate environment. They do have very good yields, and yet at the same time, the owners of these companies can raise their rents with inflation. So we'll see, but right now, if you look at this wave of buying and this wave of buying, breaking out through above this high from a few weeks back just in the last few days, this chart seems pretty promising. But again, my experience trading it is that you're often better trying to buy at the low end of a cycle move rather than trying to buy a breakout. So this ends our look at sectors this week. We continue to like tech. We're watching many others. Again, things can change a lot in the next 4.5 weeks or so till we talk again. Use good risk management, and we'll look forward to seeing you with newsletters this week.